On a trailing PE multiple, the Indian markets are trading at a 5-year low. Our view very clear that investors coming to mid-market should take a accumulate in the best long-term story. One word which comes to your mind in CY24, and this is despite the volatility that we saw in quarter four, is Nifty has given in the last 9 years positive return year on year. Will 2025 be 10 by 10?
Elections, inflation, and a lot more marked global equity markets last year. What's in store for 2025? I have with me Nitin Jain, CEO and Director with Kotak Mahindra Asset Management Singapore Private Limited. Hi Nitin, and let's start off first with what the setup is looking like for the Indian and global equity markets.
Hi Mobina. 2025 has started off to a little bit of volatile note, and we expect more of haziness before the dust settles down. But before we go into the outlook for 2025 or the market setup, let's do a recap for 2024. Now, 2024 was a very interesting year. It was a year of the ballot. Around 80 countries went through elections. There was a lot of change and there was some continuity, but it does bring in a lot of policy and geopolitical changes. For India, though, it was continuity, though with a tweak. We have Modi 3.0 as the market desired, but with coalition politics coming back. Let's do also a quick recap on a quarterly basis for the calendar year 24. Quarter one was a quarter where almost there was no bad news. We started the year on a high note of GDP growth. Earnings are pretty strong. There were opinion polls which are projecting a very strong mandate for Mr. Modi in his next term. There were some concerns regarding the SMID valuations and liquidity by the regulator, but all in all, it was a quarter where there was no bad news. Quarter two was that even bad news did not matter. We had the big event of the elections where Mr. Modi did not get majority on his party, but the coalition got majority. The market had a major reaction, but beyond that, the markets recovered within this next 72 hours. One very important thing happened during the quarter. We had the inclusion of India fixed income market in the JP Morgan bond indices. For the first time ever, India hitherto, which was just an equity investment class, has now become a full asset class with equity, fixed income, alternate assets, real estate, private equity, with diversity and liquidity. Now, quarter three was a quarter where, again, we had the repeat of the phenomena that no news was particularly bad. There was the budget, which raised the capital gain taxes, but the market shrugged it off. Market welcomed the fiscal prudence measures in the budget, where it looked to bring it down to 4.5% GDP by March 26. US yields softened. India also saw a consumer inflation print, which was 3.6%, the lowest for the year. And during the quarter, we also saw a big movement for China, where there was a expectation of stimulus. Very interestingly, despite that, China, a little bit of attraction of market in Chinese market, the global investors were big-time buyers on Indian equities in the quarter. Now, quarter four is where everything went wrong. It was a quarter of all news is bad news. We know that India went through a little bit of extreme weather in summers and then in monsoons. Those extreme weather phenomena led to a food inflation spike, which impacted the consumptions. Particularly in the weaker societies, in the lower end of the society, it impacted consumption. The government spending did not pick up. That impacted overall momentum in the economy. But the big news in the quarter was, of course, the big victory of Donald Trump. And Trump 2.0 brings in a lot of debate, a lot of noise on trade, tariffs, immigration. Of course, for US market, it also brings in deregulation and possibly tax cuts. And that brought in a phenomena of US yields moving up, dollars strengthening quite a bit, and there was a general sell-off in the emerging market. In the Indian context, the earnings for quarter three, which were reported in quarter four, were pretty weak, pretty soft, and that led to almost a double-digit correction in the markets in the quarter four. But all in all, 2024 was a decent year. We ended the year with almost close to a teens return in the main index, and the SMIDs actually did very well. the small and mid cap indices saw a 20% plus rise during the year. 2024 also marked the emergence of a new poster child in India, the Indian retail saver turned investor. The household savings got channelized into equities, and domestic institutions, be it money channelized from pension, insurance, or investments through systematic investment plans in mutual funds, became the biggest buyers of Indian equities. This has been the hallmark of 2024. Small systematic investment plans bulged into regular large flows for mutual fund. As we look into 2025, the year has started off to a bit of a volatility. It looks in the initial phase to be volatile and challenging. Trump 2.0 will take center stage very soon. Again, as I said, talks about trade and tariff and immigration will take center stage. Emerging markets will see more volatility. How they retaliate can lead to even more volatility in the near term. From an India perspective, we do expect better news coming through. Quarter three earnings were soft, but CY in quarter three of CY23 was soft, but quarter four of CY24 should see some positive impact from the wedding season kicking off, from some demand picking up towards the end of the quarter, though it will be slightly muted as we speak. 2025 for calendar year 2025, after a weak 2024, we expect earnings to be around mid-teens, and we expect the year to end with a return on equity of Indian corporate sector, X of oil companies, to be around 17%, which is a very healthy return on equity. During the last year or so, there have been a lot of IPOs, follow-on issues to IPs, and Indian companies have also raised a reasonable amount of capital. So all in all, looks like that 2025 will be a much better year from an economic growth standpoint, as the government spending is now kicking back. The rural economy is looking to bounce back on the back of an expected very strong winter crop. There is, of course, corporate earnings, which will be much better than what we saw in 2024. But as I said, in the initial phase, we will see volatility. Notwithstanding that, we see a better 2025 from an economic growth perspective, as we saw in the last few months of 2024.
What are the sectors or themes in India that look most promising according to you?
Mubina, when you look at the Indian size of the economy, the young and the very vibrant young population of India, and then you look at the consumption levels of India across services, goods, sectors, you see opportunity all around. There is a long runway for growth. India per capita income is at the cusp of now crossing $3,000 very soon. And that will mean that there is going to be a lot more consumer discretionary wallet spending on an ongoing basis. More importantly, we look at household income rather than per capita income. We are nudging close to $15,000 per capita income over the next 2 years. That will give households ability to leverage balance sheet. When you look at it from a segment perspective, the rural economy has been in a limbo since COVID. Now it is looking to come back. So anything linked to the rural economy should do reasonably well. Indian consumer is still under-levered. Fintech companies, consumer lending companies will always remain in focus, though there are some near-term concerns on asset quality. India has been trying to walk its way into manufacturing scene, increase its manufacturing GDP from around early teens to more than 20%. That will remain in focus. We are invested in segments like e-com, quick commerce, and newer emerging sectors in hospitality, healthcare. We see that as a continuing phenomena. Telecom, as a sector, is going to see consolidation-led benefit. In certain sectors, there are some concerns, like for example, in technology, it is a toss-up between higher US tech spending, a little bit of tailwind from rupee depreciation, and the impact of AI, but we remain more neutralish. We remain a little bit concerned on segments of the market where there was exuberance in 2024, particularly within SMIDs, the small caps. We see some concerns on segments of the economy where there is less free float, there's a risk of supply. That particular cohort will be the state-owned businesses, where we saw a lot of re-rating over the last 2-3 years, but floats are thin. There is a risk of supply. So those are areas that we see some concerns. But broadly speaking, we see a more evened out growth this year across sectors.
What are the factors that will influence the way Indian markets move in 2025?
Emerging markets are subject to many and multiple factors. And mostly when we think about emerging market, we talk about risk. I would like to also talk about some opportunities, as we talk about factors that will influence India in the next few months or few quarters. Namely, some of the factors that are closely watched by us, at this point of time, is the momentum of the government spending coming back, and also to some extent the nature of the spending. We have seen the nature of spending change from a big focus on capital expenditure to a more balanced approach to capital expenditure and social spending. We talked about inflation worries in recent months on the back of a spike in food inflation. We will look at how inflation moderates, and that can lead to, while the monetary policy cycle is going to be a shallow cycle, but that will give room for the central bank to cut policy rates. We will be watching the rural economy, which can give a lot of room for growth. It has, as you said earlier, it has not done well for the last 3-4 years. That can be a big driver for the broader economy. But we'll also watch paper supply. Paper supply in the form of new IPOs, follow-ons, QIPs were reasonably strong in the last calendar year, particularly towards the end of the year. There were very large number of issuances. We believe that the pipeline will remain slightly elevated in the near term. That's the area that we will be looking to watch out for. From a global perspective, of course, it is all about Trump 2.0 in the initial phase. Talks about trade, barriers, immigration will be center stage for the next few weeks. Of course, U.S. Fed will be the policy from U.S. Fed will be watched very closely in the very near term. The dollar strength has been a big worry for emerging markets. We will watch out for that. Geopolitics continues to be an elevated concern. Oil prices have been soft for a bit. We will look to watch that. Any volatility in that can have an impact on the overall broader market. From an India perspective, there has been a bit of a change in the view on the currency, given the dollar strength. Earlier, we were expecting rupee to be, last year, we expected rupee to be fairly resilient. It was fairly resilient till the last month or so, where dollar strength meant that the rupee depreciated a bit during the year. But I think at this point of time, rupee may be a slightly more volatile currency than what we had anticipated earlier. From a medium-term perspective, we will also watch out for possible positive news around India rating, though we think that is more like 2026 event, where India could be up for a rating upgrade. So many things to watch out for, but then there is a lot of positive things that we are watching out for. In India, we see a lot of dry powder at this point of time from a growth standpoint. One, the base of the growth last year was soft. So we believe that at this point of time, the market is tuned or aligned to a lower growth on GDP. There can be a surprise on the upside. We see corporate balance sheet and bank balance sheet very clean, and that can be a big driver for private capex cycle and manufacturing cycle to kick up. And the per capita income, as we talked about, it can get supplemented by a little bit of balanced spending by the government. Rural economy, as I said earlier, the consumption levels are pretty low. That can be a big dry powder for broader, a uniform economic growth in India. And also, very importantly, as we speak, foreign investors have become underweight India. They haven't done any significant investment in the last 3-4 years. Their ownership is now sitting at a decade low. From here on, we believe that also can get corrected, and India, which is traditionally an overweight market, can again find favor. So all in all, there are multiple positive factors also that we are watching out in year 2025. And lastly, I would like to highlight that the poster child, again, the Indian retail saver turned investor, only 4% of Indians invest in mutual fund as we speak. That has doubled over the last 3 years. But we see a big room for that number to grow. And we hope that the retail investor momentum continues through the year.
What are the valuations looking like right now?
Yeah, so as we go into 2025, it is very interesting to note that on a trailing PE multiple, the Indian markets are trading at a 5-year low, on a trailing PE multiple basis. Uh, as we look at, while on absolute basis not cheap, but at least that sounds reasonable from a trailing multiple PE when you look at December ending multiples for the last 5 years. Also, when you look at it from a market expectation perspective, market is now anchored to a weak earnings outcome, and a negative surprise is no longer negative. So that's the first point. Now, when you look at headline valuation, we are at 19 times odd 1 year forward multiple. We are expecting a 16% odd earnings growth. We are expecting a 17% ROEs by the end of the year, ex oil companies. Net to net, at these levels of market valuation, there is a downside risk, but downside is limited, and there is a reasonable upside risk driven by a strong earnings outlook. So at this point in time, our view on valuation is that it is in comfortable zone. Mid-market valuation is at a premium to the large cap valuation, but mid-market earning growth is also expected to be 3-4% higher than the large cap earning growth. So compensated for the valuation for the earning growth, the valuation is reasonable. But our view on mid cap remains very clear that investors coming to mid market should take a 2 to 3 year view and not take a short term view of the market. So that's where the valuation stands.
How should foreign investors approach Indian markets?
If one can summarize the foreign investor attitude towards India, or when you look at the aggregate flows towards India in 2024, one word that comes to your mind is indifference. Because there was almost negligible sell or positive flows during the year on aggregate. But that hides a bigger picture. During the year, in a usual basis, there were 4 MSCI reviews. In all the 4 reviews, India's weight went up. Technically speaking, or just putting numbers, the number of stocks in MSCI India index was 136 at the beginning of the year, and that went upwards of 150 by the end of the year. And there should have been positive flows, but we didn't see any major passive or active buying despite weight increase of India in the MSCI basket. While there was negligible aggregate flow in the Indian market, we did see them selling $15 billion odd in secondary market, though they compensated by buying a similar amount of money in the primary market. So I think the global investor has shown some inclination to buy into new age businesses that are getting listed or growth businesses that are raising capital at this point of time. But broadly speaking, they haven't invested much. And as you said earlier, they are at a decade low of ownership in the Indian market at around 17%. Now, India represents, in our view, the best long-term growth story, young, vibrant population. India's GDP growth is expected to be at least 2 to 3% higher than global GDP growth, around 4 to 5% higher than developed market GDP growth. Yes, we know at this point of time, when the biggest market, the US market, is offering a very good investment climate, others have to offer an even better climate for attracting capital. But we think that at this point of time, global investors should use this volatility and period of weakness to buy into India. If they could use the way that the retail investors in India do investments in India through a systematic investment plan, that will help them ride the volatility. But I think despite that, what we would suggest is to use this period of weakness to accumulate in the best long-term story from a growth perspective in this decade.
Now, if you had to summarize the year gone by for the Indian equity markets in one word, what would that word be?
It's very difficult to summarize India in one word, or the Indian markets in one word. But one word which comes to my mind in CY24, and this is despite the volatility that we saw in quarter four, is resilience. We had a very resilient market for most part of the year, and that resilience comes on the back of macro stability, comes on the back of policy changes that we have done in the last 1 decade, that comes on the back of good, strong corporate balance sheet, good, strong bank balance sheet. Post-COVID, corporate profitability has risen, but more importantly, cash flows have become stronger. Banks and corporate India has worked hard to augment capital. So that has been a big stabilizing factor. Of course, again, one factor which stabilizes the market during CY24 was the retail investors flow into India. That provided capital for growth. That also provided to offset the secondary market sell down by global investors. So that provided resilience to the overall market. Indian markets were resilient to global bad news, which was in the form of either US yields moving up or oil prices moving up and down or geopolitical challenges being heightened. So resilience is a very interesting word and important word to characterize 2024. Now, when I look forward, and how do we look forward into 2025 from that perspective, it is interesting to note that in the last 15 years, MSCI has given positive returns in 11 years. Nifty, the large cap index, has given positive returns in the last 13 years of the 15 years. Very interestingly, Nifty has given in the last 9 years positive return year on year. Will 2025 be 10 by 10?
Thank you, Nitin. This was indeed an insightful conversation. And thank you, viewers, for tuning in. For more such insightful videos, don't forget to hit the subscribe button.